Welcome back to the deep dive. Today we're looking at a fascinating figure, Ted Weschler.
Right.
One of the two managers Warren Buffett handpicked to help run the Berkshire portfolio.
And he's a name that comes up constantly when people talk about the future of Berkshire. A potential chief investment officer.
What's so compelling, though, is his track record before Berkshire. I mean, it didn't just rival Buffett's. In some periods, it completely blew the market away.
That's really the mission for us today. The sources we've got lay out his career DNA.
Mm-hmm.
And he's not just a stock picker. He's this kind of hybrid investor.
Hybrid.
Yeah. Our goal is to really break down the specific strategies, both in his fund and, in that famous personal account that made him so successful and so critical for Berkshire's future.
Okay, let's get into that DNA. Because his background is, well, it's not the typical path.
Not at all.
He's born in 1962, goes to Wharton, graduates in 1983, finance and accounting. So far, so standard.
The standard entry ticket, exactly. But then he takes a hard left turn.
Right. His first 6 years, he's not on Wall Street. He's working inside an industrial company, W.R. Grace & Company.
And that's the first piece of the puzzle. That's the internal operational insight. He's not just reading filings. He understands the cost structures, the capital allocation.
He's in the trenches.
He's living it. And after that, he spends a whole decade, from 89 to 99, at a private equity firm, Quad C Management.
And private equity is a completely different ballgame than public markets.
Totally different.
Yeah.
That's where he gets what our sources call the control-oriented long-term owner's mindset.
Meaning he's not thinking about stock tickers.
No. He's trained to think like an owner who might have to buy the whole business, fix it, restructure it, and then maybe sell it years down the road. It's about finding and fixing inefficiencies.
So you combine those three things: the Wharton fundamentals, the operational experience, and then the private equity mindset. What does that actually look like in practice for an investor?
It means he looks at a company like a CEO would, not like a trader. He's analyzing it as a whole business he could own, operate, or even, break up. It gives him a level of conviction you just don't get from staring at a screen.
And he put that conviction to the test in 2000 when he starts his own firm, Peninsula Capital.
From an office above a bookstore in a mall in Charlottesville, of all places.
The timing, though. It was audacious. He launches a deep value strategy at the absolute peak of the dot-com mania.
When value investing was basically a joke.
Exactly.
But it was a genius move. Peninsula operated for 11 years, right through the tech bust and the Great Recession, and the performance. It's just stunning.
Okay, let's get to the numbers.
Table 1 in our source material shows Peninsula delivered a 22.6% annualized net return.
22.6%. Annualized. Over 11 years, that adds up to a 12,236% total return?
It's mind-boggling. And you have to compare that to the market. The S&P 500 in that same period, it was essentially flat, an annualized return of 0.5%.
So he crushed the market. He even massively outperformed Berkshire itself during that time.
And if you want to see his whole skill set in one investment, just look at W.R. Grace, his old employer.
They went into bankruptcy in 2001.
Right. And he didn't run away. He ran towards the fire. He built up a huge $217 million position while the company was in bankruptcy proceedings.
But this wasn't just buying cheap distressed stock, was it?
Not at all. He later said he was essentially running a large bankruptcy for 10 years. Think about that.
A decade.
A decade-long, complex legal and financial restructuring. He was in there, actively unlocking value. It just shows he has this whole other gear most managers don't. That was the skill he was going to bring to Berkshire.
Which brings us to the job interview. My favorite part of the story. The $5.25 million job interview.
It's incredible. He sidestepped the whole HR process.
He just anonymously wins the charity auction for lunch with Buffett. Not once, but twice. Bids over $5 million in total.
It was an audition. A very, very expensive audition. And by the second dinner, Buffett was sold. He offers him a job.
And Weschler says no. I mean, who turns down Warren Buffett?
He said his first reaction was just panic. But his reasons are what actually sealed the deal.
What were they?
Well, he mentioned his family was settled in Charlottesville, but the crucial part was his fiduciary duty. He told Buffett he had to see that 10-year W.R. Grace bankruptcy through to the end for his partners at Peninsula. He couldn't just walk away.
Wow. So prioritizing his integrity over the biggest job offer of his life.
And that was the final test. That's exactly the kind of character Buffett looks for. It aligns perfectly with Berkshire's whole culture. So Buffett just said, okay, I'll wait.
Incredible. Okay, let's shift to the part of the story that really is jaw-dropping. His personal wealth, which came to light in that 2021 ProPublica leak.
The secret IRS files. We're talking about his personal IRA.
An account he opened in 1984, By 1989, it had about, what, $70,000 in it?
70,000, yes. But the really clever move was in 2012. He converted that traditional IRA to a Roth IRA.
And at that point, it was worth $131 million.
$131 million. So he pays a huge tax bill up front, about $28 million, on that conversion. But by doing that, every single dollar of growth from that point on is completely tax-free.
And the growth was explosive. Just 6 years later, by 2018, the account was worth $264.4 million.
That's the magic of tax-free compounding when you're making aggressive bets.
But let's look at the return before that conversion, growing from 70 grand in 89 to 131 million in 2012. That implies an annualized return of around 31%.
31%, which is, you'll notice, even higher than the 22.6% his professional fund was making.
That's a great point. So why was he getting even better returns in his personal account? Was he holding back on his clients?
No, I think it speaks to the constraints of managing other people's money. The IRA was his pure, unconstrained strategy. 100% equities, super concentrated bets, no clients to reassure, no redemptions to worry about.
It was his sandbox.
It was his sandbox, exactly. He said his IRA lost 52% of its value in 1990, and his mantra was, there's no such thing as a loss, it's just an unmonetized lesson. You can't really do that with client money.
That's a powerful idea. And it's worth noting, he did this all with publicly traded stocks, and he even said publicly he didn't think the tax shield he got was necessarily good policy.
So when he finally joins Berkshire in 2012, his mandate is very clear.
Expand the circle of competence.
Right. Buffett tasked him and Todd Combs with looking at newer industries and smaller deals, around the $500 million mark. They were too small to move the needle for Buffett anymore.
And you see him put his old skills to work immediately. That Detlev Louis acquisition, the German retailer.
A $452 million deal. He used his M&A background and didn't just buy it, he became the chairman. That's the control-oriented mindset in action.
And he also brought in his industry specialties, like with the huge stake in DaVita, the healthcare company.
A company he knew inside and out from his Peninsula days. But the biggest strategic shift, really, was about correcting what Buffett and Munger called their sin of omission.
Missing the big tech giants.
Failing to buy Google, yeah. Weschler and Combs were hired, in part, to fix that institutional blind spot.
Which is why that recent news of a huge $4.3 billion stake in Alphabet is so important.
It's vital. And this isn't them just chasing growth stocks. This is applying Buffett's moat principles to these mature tech platforms. They're looking at Alphabet not as a risky tech play, but as a digital utility.
A digital utility. What does that mean in the Berkshire framework?
It means it's become indispensable infrastructure, like a railroad or a power company. Search is a near monopoly. Its AI, like Gemini, just gets better with every search, creating this feedback loop that's almost impossible for a competitor to break. That is a modern moat.
Okay, but we have to address this contradiction. There was a Financial Times piece in May 2024 that claimed Weschler and Combs had actually underperformed the S&P 500 over 10 years.
Right, and that story got a lot of traction. But our sources provide a really crucial rebuttal. A huge part of their reasoning for that underperformance was one specific investment.
The disastrous Paramount bet.
Exactly. They pinned that loss on the two of them. But then, at the 2024 annual meeting, Buffett himself stood up and set the record straight.
What did he say?
He said, and this is a direct quote, "The Paramount decision was 100% my decision. I did it all by myself, folks."
So he took the blame entirely.
He took the blame, which basically blows the whole premise of that media analysis out of the water. You remove that multi-billion-dollar loss from their column, and the picture looks very different.
So that brings us to the future, to succession. For years, the plans seemed pretty clear. Greg Abel becomes CEO, and Weschler and Combs become co-CIOs.
That was the assumption. But Buffett threw a bit of a wrench in the works in 2024. He said that Abel would take control of the investing decisions at Berkshire.
Which created a lot of confusion.
A ton of it. It sounds like he's going to be micromanaging them.
But there's a key distinction here between capital allocation and portfolio management, right?
Precisely. The CEO's job, especially at Berkshire, with its massive cash pile, is capital allocation. Deciding whether to put billions into buybacks, private acquisitions, or public stocks. That's Abel's ultimate responsibility.
It's not physically possible for him to also do the day-to-day work of finding and researching stocks.
Impossible. That's portfolio management, and that remains Weschler and Combs' job. Their role is secure as the experts managing their sleeves of the portfolio. But, and this is the new reality, the size of those sleeves will ultimately be determined by Abel's allocation decisions.
So they have to keep proving their ideas are the best use of Berkshire's capital.
That's the job. Their future is secure, but their firepower depends on the new CEO's strategy.
So when you boil it all down, what does this deep dive tell you about Ted Weschler's role?
He's a complementary specialist. He's not a Buffett clone. He's the guy who lets Berkshire do things Buffett couldn't or wouldn't do anymore, like a 10-year bankruptcy workout or buying a German retailer. And most importantly, he's the bridge to the 21st century moats, the digital utilities.
So the future of Berkshire isn't finding another Warren Buffett.
No, it's about integrating specialized expertise to expand the company's competence. That's what Weschler represents.
And for a final thought, I want to go back to that personal philosophy of his. There's no such thing as a loss. It's just an unmonetized lesson. It's such a powerful way to think about investing psychology.
It really is.
So think about that for yourself. Take a major investment loss from your own past. We all have one. How could you reframe that single event, that moment your conviction was wrong, as an unmonetized lesson that could make you more successful in the future? That's definitely something to mull over.